This is Your Money, Your Wealth.
Hey, welcome to another edition of Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. Thanks for tuning in. Got a great show lined up. Here's a crazy statistic. Now, when you think about what is the biggest fear that people have in their life, think about it for a second. Most people will say death. I don't want to die. But it has changed today. For years, it was death and public speaking, okay? Now it is living too long. Wells Fargo just did a study. 22% of people would rather die than run out of money. That is crazy. That is a scary, scary statistic. So we do not want that to happen to you because are you kidding me? There's so much more to live for. You just got to get some planning done. That's what this show is all about today, and that is what's on my mind. So we're talking about fears. 22% of you would rather die than run out of money in retirement. Now, there's a lot of things that you could potentially do, but here's the troubling statistic is that most of you are not doing anything about it. If you look now, 40% of people are not saving at all towards retirement. For those of you that are saving, 60% have less than $25,000 saved, 30% have less than $1,000. So if 22% of you are so freaked out about not having enough money in retirement that you would rather die, you're not doing anything about it. So you have to take ownership of this. So to bring in the conversation, let's bring in Big Al Clopine. Big Al?
I think there's got to be a better plan than dying, don't you?
I would think so.
I would hope so anyway.
Well, they got to tune into the show to figure out exactly what they need to do so they don't die.
Absolutely, and that's why we're going to focus today on what you need to do in retirement. And some of you are behind, many of you are behind, we know that. So watch the rest of this show to figure out how to get back on track. But first, we had a chance to go out and talk to you guys. What is concerning you?
My biggest concern is just being able to do the things that I want to do in retirement, which is, do a little traveling, make sure that my family's secure.
Having enough money for retirement to live in the lifestyle that we would like to live.
Just living a comfortable retirement without worrying about making a payment here and there.
So I wanted to learn how to keep our money. It's a big deal.
That's the first step, right? You want to make sure that you identify your goals. What is important to you? Is it not making a payment? All right, you want to be debt-free. That's a pretty good goal.
That's a good goal, yeah.
Right? All right, I want to preserve the things that I have. I want to do all the things that I want to do in retirement. It all starts there to figure out exactly what that retirement dream looks like and then work backwards to figure out, all right, well, how much money that you need to save and then how does the portfolio look, taxes and so on.
Yeah, absolutely. And I think right off the bat, when you think about saving, a lot of you that are saving, or maybe you want to start saving, it's like, well, where do I save my money? And a lot of people are so afraid of the market right now, right? It's volatile. It's going up, it's going down. We don't really trust it, right? So let's just put our money in safe investments like savings accounts, CDs, which are certificates of deposits, or money market accounts. We know those don't pay a lot in interest and so forth. But at least we don't lose money, or so we think. If you take a look at the Wall Street Journal, they told us that over 50% of the portfolio investments are in cash-type investments. And that's, again, savings, that's CDs, certificates of deposit, money markets accounts, and so forth. And I want to talk about why that's not such a good strategy. And we've got a slide that'll show here in just a second. And that is the savings. If you, let's say for 30 years, if you're able to save $10,000 a year, you put it in cash accounts, you earn 1%, which you'd be lucky to get right now. So in 30 years, you'd have $348,000. Not bad. But what if you did that same $10,000 in a diversified portfolio, meaning stocks and bonds, domestic and international, at a 7% rate of return, you'd end up with $945,000. So about $600,000 more. And that's a big deal when you're thinking about your retirement.
Well, it's a huge deal. And then, but here's the problem is that, all right, well, here I'm approaching retirement. I do not want to take any risk with my investments. So here's what I'm going to do. I'm going to go into something safe, such as CDs, money markets, stable value funds. But if you look at that, you're losing money safely. Inflation and taxes will take everything from you. If you look back, I mean, this is not the 1980s. right? We're in 2014. In the 1980s, you could buy a one-year CD and get 15, 16%. You got 100 grand, you got $16,000 income, boom, that year. If you're lucky to get maybe $16 of income per year on a CD today. So you have to take a look at the power of inflation over your lifetime. And then you have to look at what is the appropriate investment strategy to make sure that you outpace inflation and you outpace taxes. Because it's not necessarily just market risk that you have to be considering. You have to look at all risks and then making sure that you are hedging against all of them to make sure that you have the appropriate portfolio.
Yeah, so make sure you're saving in the right places. And we know that from a recent study, about 58% of you have never even calculated how much you need in retirement. And to do that, you just have to, there's a couple methods that we'll go through. There's actually several methods, but we have time for a couple methods. And the first one is 8 times your final pay. So this only works if you're near retirement and you can sort of calculate your final pay. Let's just say it's $100,000 a year. You multiply that by the number 8. And so you need somewhere around $800,000 to continue your lifestyle, at least close to continuing your lifestyle. So that's at least a metric.
So 8 times, so 800 grand. I mean, but if you take a look at the average balance of a 401k plan, it's about 250,000.
Exactly, or less. Yeah.
Right. So I mean, that's just giving you an idea of what you need to have just to maintain the current lifestyle that you're accustomed to. These are huge numbers. We understand that. It's never too late to start. We're going to talk about how, if you're in your 30s, 40s, 50s, or 60s, what are some of the things that you can do? Let's look at another quick example of what people should look at when they're calculating income.
Yeah, so a second one would be saving 15% of your take-home pay on your salary. So let's go through that. Your gross income is $100,000. That's your pay. But that's not what you're taking home because of payroll deductions. So $70,000 is what you're receiving over the course of the year. Multiply that by 15%, you get $10,500. If you save that for 30 years at 6%, you end up with $800,000+. Now, for some of you, it's a little too difficult to do that way. Just take your gross pay times 10%. You get almost the same number. But that's about what you want to be saving, because by doing that, you'll be able to somewhat continue your lifestyle. And I know what you're thinking. A lot of you are thinking is, you know what, I'm 45, I'm 50, I'm not even close.
Right, and it's procrastination. Right. And then you look at these numbers, it's like, hey, I can't save 15%. Are you kidding me?
Exactly.
I'm lucky if I can save 3 or 4%. Al and I had Chris Thornburg on, who's at Beacon Economics on our radio show. If you haven't checked out our radio show, please do so on KFMB. But he was talking about China. Guess how much they save of their income? Right?
Yeah, it's up there. Was 30%.
40%.
40%. Yeah.
40%. So if you take a look, we're saving maybe 2 or 3%. Other countries are saving 10 times that. So now is the time really to take a look at what you're doing, what your goals are, to make sure that you can accomplish all the things that you want to accomplish. It's a big deal. If you want to retire and don't want to be part of that 22% of saying, man, I'd rather die than run out of money, now is the time to get your plan in place. If you want our help, we're giving away a retirement review. We can look at everything for you, give you an idea of if you're on track, not on track, how much money should you be saving. You start out slow and then you continue to build on that. If you're 30, if you're 70, it doesn't matter. There's always room for improvement, and it's always time to start, and it's time to start right now. Call the number, 888-994-6257. We're just getting started. We're going to get through some real examples of what you can do if you're a little bit behind the 8 ball, and you'd be amazed on how fast your money can grow. You're watching Your Money, Your Wealth.
I have 2 boys, and I would like to help at least one of them to buy a house. If I take money out of my IRA, will I be taxed on that?
This is Matt Horsley, Certified Financial Planner with Pure Financial Advisors. Did you know that the current U.S. national debt is roughly $17.9 trillion? That's roughly $51,000 for every man, woman, and child in this country. For the family of 4, on average, that's roughly $200,000 per family. And considering the median family income is about $52,000 per year, each family would have to work for 4 years just to pay off our debt.
Hey, welcome back to Your Money, Your Wealth. Joe Anderson here, Certified Financial Planner, alongside, of course, Mr. Alan Klopline. Hey, before the break, we had a question. Let's go back to that and see what we can do for him.
Hey, Joe, I'd like to ask a question. I have 2 boys, and I would like to help at least one of them to buy a house. If I take money out of my RA, will I be taxed on that?
Well, yes, you will be taxed on it. Anytime you take any money out of an IRA, Al, you're always going to be taxed on it. But I think on another thing you want to look at is there going to be a penalty?
Yeah, exactly. So if you're over 59 and a half, you can take as much as you want out. You do pay tax on it regardless of what you use the money for, but you don't have to pay a penalty. When you're younger than 59 and a half, then you can take out $10,000 for a first home. It can be for your home or your kid's home. And yes, you do pay tax on that, but you avoid the 10% penalty. But the real question is, should I do it?
Yeah, I mean, what's the name of the account? It's called an IRA. It's an individual retirement account. It's not a slush fund for your kid's home. So you want to use that as retirement. You want to use other sources to basically help your kids out.
Exactly. It's for you. It's for your retirement. So we would strongly recommend that you not take that money out of that IRA for the kid. But those are the rules. So again, we're talking today about what people are doing in retirement. They're making some mistakes, they're way behind, and so we're going to focus on what you need to do right now. And again, just to kind of show you, we went out on the street and talked to you about, again, what some of your concerns are.
I'm in the construction business, so I'm getting older. I thought I could work forever, but I'm finding little bumps and bruises and pains and aches, and I don't know how long I can do it.
John has spent his career working in the family construction business in East County. But without a company 401k or pension plan, retirement is not a given for him.
I'm 55 right now, so right now I got planned on 10 years. I would like to do 5 years, but I think 10 years is more realistic, and then see what I can do.
John has some money saved, but not nearly enough to retire.
So I was raising a family, and life gets in the way, and I just didn't do it, so I kind of don't want to blame about myself, but I'm hoping to try to do a little catch up now.
With about a decade of working years ahead, John knows he needs a plan, but like many other people his age, he doesn't know what to do.
Who knows what the future holds, but you got to plan for it.
That situation reminds me of home. My father was a cabinet maker. He put 3 kids through school, worked and worked and worked, and really didn't pay attention to retirement until it's too late. And I get it. If you're a small business owner, every single penny counts to keep that business alive, and then you don't necessarily think about retirement. It's worrying about, all right, well, here I have to pay payroll, I have to get the next job done, I have to put food on the table. This is so common with most individuals. But it's not hopeless, right? There's always things that you can do if you get a good plan in place.
Well, that's exactly right. And so this is pretty typical. We see this all the time. And the tendency is, well, I'm 50, I'm 55, I'm 60. It's too late. I just can't do anything. And we're going to show you, no, that's not true. We're going to give you some examples. But right off the bat, where do you start? You start by creating a written plan. You probably heard that before, but very few people have a written plan. And what does that plan entail? Well, first of all, when are you going to retire? Is it 65? Is it 67? Is it 70 years old? Have a sense of that. And look at what your spending goals are. Figure out how much you want to spend in retirement. And then start saving. Start saving today, even if you're 60 years old. And we're going to show you an example. If you have nothing at age 60, you can still end up all right, okay? Because with a 401k and a 403b, you can save $17,500 per person, or $23,000 if you're over 50. And an IRA, Roth IRA contribution, you can save $5,500 and $6,500 if you're 50 and older. So Joe, why don't we get into some examples, because it's really easy to talk about what you should do, but when you see the power of compounding, it can help motivate you to take action.
All right, so this is for the younger generation. All right, so if you take a look, let's start with a 30-year-old. All right, so now, most people in their 30s, right, they get their job and all of a sudden they start making a little bit of money. And what we find is that, all right, instead of saving, because retirement is still 200 years from now, then I want to get a nicer car, or I want to have the nicer clothes for work, or whatever the case may be. But if they foregone the car, so they didn't buy the nice car, so let's say it's a $400 lease payment, maybe it's a $400 car payment, whatever it is. So you drive the beater still, but you put the $400 into your retirement account, okay? So at a 7% growth rate, over the 30 years, you have close to $1 million, $720,000. That's just $400 a month of savings. Now, let's say if this 30-year-old really wants to attack retirement and says, all right, I'm going to max out my retirement account. So I'm going to put in $1,500 per month into the overall plan. You take a look at that same 7%. Now you got $2.7 million at retirement. So it's $400 a month. So if you're in your 30s, find a way to save a little bit of cash. Now, if your employer has a match, that's even more money that's going to compound for you where you're going to have these dollars. So you don't have to wait until you're 50 and you're 60 and figure out, hey, I haven't done any savings. Because $400, that's not that much money. Now let's go to someone that is a little bit behind. So let's look at a 50-year-old that hasn't done any savings. All right. So now let's say that instead of having 2 car payments of $400 a piece, you get rid of that and you can find $800. So 50 and you retire at 67. That's 67, you still have probably 25 years of retirement. 67 is still very, very young in today's environment. So 50-year-old wants to retire at 67, and they can scrounge up $800 a month, right? Now they have $312,000. They're starting from zero, now they have 300 grand. This is not a long time period, and 800 isn't that much money in the grand scheme of things. But now, let's say they get really excited, say, you know what, now the kids are out of school, we have some extra cash flow, we haven't saved any money. They can come up with $2,000 a month, right? $2,000 a month, $24,000 a year. So they're maxing out their 401k plans. Now at 7%, $1 million. So from 50 to 67, now you retire at 67, you have $1 million plus your Social Security. Now you're looking at a very comfortable retirement. It's just tweaking the numbers a little bit. Can you find a way to squeak out a couple of extra bucks to put towards your retirement accounts to make sure that you have the retirement of your dreams? It's just looking at the numbers, saving a little bit of money. The compound interest is going to be the best friend that you possibly can. And that's all people really have to do is do a little bit of planning and figure out a way. Maybe it's not $800 at first, maybe it's $200, $400, then you build up to it.
Well, Joe, that's the absolute key, which is if you can't do $400 or you can't do $800, what can you do? Can you do $100? Can you do $200? Realize when you're saving into a retirement account, you're getting a tax deduction. So if you're in a 25% tax bracket, if you save $100, you're also saving $25 of tax. So it's really only costing you $75. So factor that in as well. But the thing is, especially when you're in your 50s or even 60s and you haven't really done much, here is the thing. You got to get started, and you got to get started now, because if you wait, you're going to be 65, 70, retiring with nothing. And you don't want to be one of those people.
Right. I mean, here's what happens, Al. It's just like hopelessness. It's like, okay, well, here I'm 50. I don't have any money saved at all. And I just can't do it. You know, I'm just going to keep working. And the next thing you know, you're 60, then you're 65, and then you're 70, and then now what? So you're absolutely right. Right now is the time to start. If you haven't started, start right now. If you need our help, we'll be more than happy to map things out for you. Here's the number if you want to come in for a free retirement review. It's 888-994-6257. 888-994-6257. There it is. All you got to do is read the number. Boom. Don't go anywhere, guys. We're going to be right back. We got a lot more to discuss when it comes to your overall retirement. You're watching Your Money, Your Wealth.
Hi, Al and Joe. If my husband and I file our taxes separate, can we put more into our retirement fund?
Hey, welcome back. Joe Anderson here. You're watching Your Money, Your Wealth. Happy Saturday morning, everyone. Hopefully you're enjoying the show. We're having a great time talking about money in retirement and some of the things that you need to do to get on track. The best time to start is to start right now. Here's something that can help you. A lot of times people don't want to go and sit down with a broker, an insurance agent, a certified financial planner, whatever the case may be. Maybe you want to do this stuff on your own. Well, great. Here's an opportunity. If you would like to go to a retirement planning course, I teach a retirement planning course, ironically, all over Southern California. All you have to do is go to the website, yourmoneyyourwealth.com, and you can check out a local community college or school near you and attend. We still have a few more classes until the end of the year, or we start right back up again in January. If you want to take advantage of it, it's free of charge. We will pick up the tuition. It's usually anywhere from 40 to 70 bucks, but we are very dedicated to educating you to make sure that you make the best moves out of your money. We want to answer your questions. So we're out on the street. We have more questions, so let's answer this one.
Hi, Al and Joe. If my husband and I file our taxes separate, can we put more into our retirement fund?
That's a great question. So
it is, and I'll take that one because she addressed me first. So the answer, the answer
you go,
is,
boy.
I know. The answer is no. Whether you file jointly or separately, it doesn't make any difference.
It actually can hurt you too.
Yeah, it can. But the question was, can I put more in? The answer is no. In some cases, less. Like a Roth contribution, there's lower income limitations to where you can't actually get that much in. So no, filing jointly or separately makes no difference in how much you can contribute to your own retirement plan.
Hey, Alan, so let me ask you this. Why would someone want to file separately? Because if you look at a Roth IRA contribution, the IRS doesn't really care for you filing separately, because if you make more than $10,000, you can't contribute to a Roth. So that's telling me that the IRS is saying, hey, why would someone want to even file separately?
Well,
because I think there's a lot of misnomers. Hey, if we file separately, we're going to pay less tax.
It's a good question, and we get that all the time. If I file separately, am I going to pay less tax? And the answer is almost always no. And the reason is because we live in a community property state. California is a community property state, and by definition, half of my salary is my spouse's, half of my spouse's salaries is mine. And so if we file two separate returns, they mirror each other. And the tax rates are actually higher for filing separate when you put those two together. Now there's one exception, and that is if you have assets before marriage that are generating a lot of income. You might look at that as long as they're separate non-community assets. But that's about the only time. In almost all cases, you're better off filing joint.
Hey, I'm going to ask you this because I think people are probably thinking about this too. Let's say I'm married. Would it make sense for me not to be married? Is that going to save me any money in tax? Filing a single return, let's say both my spouse and I, we get a divorce, we're still together, and we file separate returns. So is there a marriage penalty now with the overall tax code if I am married? Am I going to pay more tax? Is it costing me even more, let alone heartache and pain, but now even more tax money if I continue to be married?
Yeah, are you asking for yourself?
I am single, my friend, and that is a very
okay.
good, that is why.
Just wondering. Okay, so the answer is it depends. It depends on what? Your income level. So let's say one spouse works and the other spouse doesn't work. Well, you're actually going to pay less taxes filing married because they're the same tax brackets, 10% tax, 15%, 25%, and so on. But when you're married, you hit those upper brackets later on. So you actually do better. Now, if you're both working and making somewhat similar income, you're probably worse off getting married, but again, it still depends upon your income level. So even though in the lower income levels, the marriage penalty, the so-called marriage penalty is gone, it happens when you're making 80, 100,000, 120,000 and above. The both of you, almost definitely, you're going to pay a little bit more filing married. So we do get that question, well, should I just go to Vegas and get divorced on the 31st and then married on January 1st? Well, you can if you want to. That actually does work. Because
hopefully love and harmony is worth more than a few dollars in tax.
Yeah, because it's your status on December 31st. But yeah, is it going to be beneficial to your marriage? Probably not, is my suggestion.
All right, well, let's go to the email bag because we're answering questions here. Let's go to the email bag. Al?
All right, here we go. I am 52 years old and I have no retirement savings at all. I know I'm way behind and I don't know how to get started. What would you suggest? This is Richard in La Mesa. And I got to say, Richard, thank you for asking that question because a lot of people don't want to ask that question and it's a very important one. So I've got a slide here that I kind of want to go through to tell you exactly what to do. And I'm going to make it a little bit more generic. I want to start with a 55-year-old and a 60-year-old. Now, you're only 52, so all the better for you. But here's the key. Start now. Start today. Cut your spending as soon as possible because if you don't, you're going to go over a cliff. By the time you hit retirement, your spending is going to be a lot lower. When you cut the spending, try to maximize your 401k account. If you're over 50, it's $2,000 per month. The employer match, take advantage of that. Commonly, that's 4%. And if you retire at 67 instead of 65 at a 7% rate of return, let's look at that. Age 55, you end up with $500,000+ at retirement. Age 60, it's still $250,000. Now, $250,000, you're not going to live like a king and queen, but you're ahead of the game. You're ahead of most other people. So if you're 60 with no savings at all, get started today. There's still hope for you. And in some cases, if you're 60, maybe you want to work till 70, 72, you still end up with that $500,000.
I guess the point is you got to start right now, and if you start at 55 versus age 60, you're going to have a lot more money. $250,000 is still no chump change, right? So you can still generate some income there, then you have Social Security and so on. But if you're behind the 8 ball, you probably want to work as long as you can, push that thing out, and save as much as you can, because the compound interest is pretty powerful. Let's answer one more email question and get the heck out of here, Al.
Okay, my parents are giving me $14,000 a year. This will be a gift. How much do I need to pay in taxes on the gift? This is Brian, Pacific Beach. Well, the quick answer is nothing. A gift is tax-free to you. So fortunately, there's no tax to pay at all. So that $14,000 you got, Brian, you get to spend it how you want.
All right. Well, Al, I mean, you're the smartest man in the room right now. You are the smartest man on TV.
Out of two of us?
On Channel 4 at 11:29
well, I'm
a.m.
in the top 2 anyway.
You are definitely in the top 2. Hey, thanks so much for joining us. Hopefully you learned something. Here's I guess, the end-all be-all. It's never too late to start. Start right now. Start saving as much as you can. And then watch that money grow. Don't necessarily get caught up in the gyrations. Just start saving money and then look at it in 15 years. You're going to be a happier person. Join us, 888-994-6257. Call that number right now. Get in for a free retirement review. I'm telling you, it can change your life. For Big Al Clopine, I'm Joe Anderson. You just watched Your Money, Your Wealth. Have a wonderful, wonderful weekend.